Assalamualaikum and welcome back to the part 2 of this chapter. Basically, this video is going to cover the last 3 parts of your learning outcome to complete chapter 2. Let us start with the general market condition which link to the investment world. Have you ever heard the terms bull market and bear market? A bull market is a favorable condition of a financial market in which prices are rising or are expected to rise. The term bull market is most often used to refer to the stock market, but it can also be applied to anything that is traded such as bonds, real estate, currencies, and commodities. Bull markets are also characterized by optimism, investors' confidence, and expectation that strong results should continue for an extended period of time. Bull markets generally take place when the economy is strengthening. They tend to happen in line with strong gross domestic product, a drop in unemployment, and often coincide with a rise in corporate profits. Investor confidence will also tend to climb throughout a bull market period. The overall demand for stocks will be positive, and there will be a general increase in the amount of IPO activity during bull market. However, there is no specific and universal metric used to identify a bull market. Perhaps the most common definition of a bull market is a situation when at least 80% of all stock prices rise over an extended period. And another indicator is if market indexes rise at least 15%. The opposite of a bull market is a bear market, which is characterized by falling prices and typically shrouded in pessimism. There are a few ways a bear market can be determined. One method states that a bear market occurs when there is at least a 20% decline from the biggest high in the last year. According to the US Securities and Exchange Commission, a bear market occurs when a broad market index falls 20% or more over a 2-month period. In the bear market, the economy is slowing down. Stock market is in downtrend because investors lose their confidence. GDP falls, unemployment goes up, and severe contraction phases can lead to a recession. As a symbolic of rising and falling conditions surrounding stock market, statues replica of both bull and bear was also built outside our local exchanges of Bursa Malaysia, as well as in other countries. But have you ever thought of all other animals, why bull and bear were chosen? The commonly held belief about the origins of this term suggests that the use of bull and bear to describe market comes from the way the animals attack their opponents. A bull thrusts its horns up into the air, while a bear swipes its paws downward. So these actions have become the metaphor for the movement of a market. If the trend is up, it is called a bull market, and if the trend is down, it's a bear market. The globalization of securities market is important because today investors seek out securities with high returns in market other than their home country. For the purpose of portfolio diversification, investors may invest in companies based in countries with rapidly growing economies or choose international investments. With securities exchanges, both large and small, operate in more than 100 countries, it provides opportunity for investors, especially institutional investors, to compete more efficiently in a cross-border market. To achieve some degree of international diversification, an investor from Malaysia, for example, can make foreign security investment either indirectly or directly. The investor can diversify indirectly by investing in shares of Malaysia-based multinational companies with large overseas operations that receive more than 50% of their revenues from overseas operations. Investors can make this transaction conventionally through their stockbrokers. The procedure is similar to buying a domestic security. An investor can also purchase foreign securities indirectly by purchasing shares in a mutual funds that primarily invest in these securities. Direct foreign investment, on the other hand, can be achieved by purchasing securities on foreign exchanges or by buying securities of foreign companies that are traded on Malaysia exchanges or over-the-counter market. Although by investing internationally could provide opportunity of higher returns, the investor must be aware of the additional risks involved, such as country risk, different government policy and market regulation, as well as foreign currency fluctuations. Investor must consider risk beyond those in making any security transaction. In particular, investor in foreign market must bear risks associated with doing business in the foreign country, such as trade policies, law labors, taxes, and political instability. Okay, this slide particularly shows the trading hours of our equity market. The pre-opening market is the period of trading activity that occurs before the regular market session. The pre-market trading session occurs between 8:30 a.m. and 9 a.m. for each trading day. Many investors and traders watch the pre-market trading activity to judge the strength and direction of the market in anticipation for the regular trading session. It is very important to remember that there is very little activity for most stocks so early in the morning unless there are significant news, for example, on the night before the trading day. The final learning outcome of this chapter that you must know is the three basic types of securities transaction, which includes long purchase, margin trading, and short selling. The long purchase is a transaction in which investors buy securities, usually in the expectation that they will increase in value and can be sold at a later date for profit. So the basic concept of long purchase is to buy low and sell high. This transaction is the most common type that investors practice. When investors make a long purchase transaction, the return that they earn can come in the form of dividends, interest, or capital gain or loss between the purchase and selling price. Margin trading. Margin is the money borrowed from a brokerage firm to purchase an investment. It is the difference between the total value of securities held in an investor's account and the loan amount from the broker. Buying on margin is the act of borrowing money to buy securities. The practice includes buying an asset where the buyer pays only a percentage of the asset's value and borrows the rest from the bank or broker. The broker acts as the lender and the securities in the investor's account act as the collateral. The most significant advantage of using margin is the ability to leverage your investment and increase the returns when the price of your holding is moving in your favor. Now let us look at the example. When you have 20,000 worth of security bought using 10,000 borrowed money and 10,000 in cash. When the value of these securities rises, let's say by 25%, total value of your securities become 25,000. Although the amount of your borrowed money from your broker stays at 10,000, you can see that your equity now becomes 15,000. That means your equity grew from 10,000 to 15,000, which is a 50% growth rate. So this is a simple example that could explain the power of leverage using margin trading. Short selling, on the other hand, is a strategy to use when you expect a security's price will decline. The traditional way to profit from stock trading is to buy low and sell high, like what I've mentioned on long purchase just now. But with short selling, you do it in reverse order when you wish to sell short. Sell short means you sell shares of a security that you do not own, which you borrow from a broker. After you short a position via a short sale, you eventually need to buy to close the position, which means you buy back the shares later and return those shares to the broker from whom you borrowed the shares. You can make a profit from short selling if you buy back the shares at a lower price. However, your losses are theoretically unlimited if the stock price goes higher and higher. Let us review the short selling example below to see how short selling for a stock works. An investor believes that stock A, which is trading at 100 per share, will decline when the company announces its annual earnings in 1 week. Therefore, the investor borrows 10 shares from a broker while short sell those shares to the market. So now the investor shorts 100 shares of stock A, which he did not own, with hopes that the price will decline. 1 week later, stock A's price falls to $90 per share after the company announces annual earnings. So the investor decides to close the short position, so he buys back 100 shares of stock A from the open market at a price of $90 per share and returns those shares to the broker. This is a buy to cover order. Therefore, roughly the investor makes a profit of $10 per share, which is a total of $1,000 for the whole transaction without taking into account commission and interest charged by the broker. However, if the stock price increases to $110 per share and the investor decides to close the short position, he will need to cover the 100 shares from the open market at the current price of $110 per share. The loss for this short sale transaction will be $10 per share, which amounts to a total loss of $1,000, excluding commission and interest, since the stock shares were bought back at a higher price. So, from this example, you can see clearly the benefits as well as the risk of short selling transaction. Looking from the Islamic perspective, the conventional short sale is selling a stock which investor does not actually own, a transaction which would clearly violate the general Islamic rule of do not sell what you do not own. But in Malaysian market specifically, we have what is called as regulated short selling, RSS, in Bursa Malaysia. So for further reading on what is RSS and how it is different from the regular short selling, I will share some of the relevant article on it with you, and you can also search this information from the website of Bursa Malaysia.